Great. Yeah, so 6045, this is such a huge topic to discuss. Um, as you guys know, these proposed regulations came out a few months ago. So let me kind of give you like a quick refresher on what happened, what you need to know as practitioners and maybe as clients as well. Then I'm also looking forward to share some of the industry insights we gathered right after we got these proposed regulations. And some of the things that you should be aware about as we were speaking. There are some things that the industry is doing to make sure like some of these things are taken care of properly before these regulations get finalized. So I'm looking forward to kind of share some of those items as well. If you go to the next slide. So just a quick refresher, proposed broker Regs 6045 regulation package was a part of the infrastructure bill that passed in 2021. After its passage, a lot of people waited for these regulations because they were curious who's going to be a broker, what type of reporting requirements these brokers will have to comply with. Will DeFi be covered by that? Those are some of the common questions that we heard. So we had to wait like at least a couple of years before we saw these proposed regulations. It came several months ago. 300-page, very exhaustive, package. According to this proposed broker regulation, this is the definition. A broker is any person that in the ordinary course of a trade or business stands ready to effect sales to be made by others. The regulations go into further defining the term effect. So basically, if you're in a position to know transaction that the users are doing, or if you're acting as a middleman facilitating certain digital asset transactions, you could be classified as a broker. Needless to say that this definition is very broad, and we saw like a lot of comments concerning how broad this definition is. To keep things simple, according to this proposed broker regulations, you can see 5 categories of brokers. The idea here is that if you're a broker, you had to do what's called information reporting, which I will go through in the next slide. So what are the 5 categories of brokers? Digital asset platforms. These are pretty clear. These are like centralized exchanges like, Coinbase and Gemini, and they will be classified as a broker. I don't think this was a surprise for the industry. Actually, these regulations actually clarified that those platforms should be treated as brokers. So I don't think that was a surprise. The second category of broker are digital asset hosted wallet providers. There's little nuances here, like if you have a wallet software like MetaMask or something like that, and that wallet has some type of swapping feature, then that wallet could be classified as a broker. So this was somewhat surprising to the industry. And again, there were like a lot of comments on this as well. The third type of digital asset broker is digital asset payment processes. So these could include companies like BitPay and other payment processes. And basically they have to do information reporting because they're in the business of taking digital asset from somebody else and converting it to something. And as a result, they become a broker. The fourth category is other brokers. For example, stable coin issuers. So they're in the business of, having certain type of coin, and they redeem this coin into USD and vice versa. And as a result of that conversion, like you can be classified as a broker. The last category is real estate persons. I don't see this category very often in the industry. Basically, if you're buying or some type of real estate, like a house or something like that, and instead of paying cash, you're paying crypto. In that case, the intermediary in that transaction chain could be treated as a broker who has to do, what's called information reporting. If you go to the next slide, so I've been talking about information reporting, and what does that mean? As practitioners, this is not something that we typically do. When we prepare the tax returns, we actually consume information reports generated by exchanges and other financial institutions, but we don't produce information reports. So let me kind of give you a breakdown of what information reports is, because this is one of those concepts in the industry that's not widely understood. So I thought it was a good idea to kind of give a good overview of what information reporting is and what it takes to run an information reporting function in a business. So the information reporting involves three things. First, you had to identify who's doing transaction on your platform. So to do that, you need to do KYC, you need to collect your W-9, and you need to do the TIN verification. Once you identify who's doing transactions on your platform, then you had to compute certain amounts like gains and losses and income items internally. And again, this kind of takes like massive effort when it comes to human resources and also technological resources as well. So once you identify and compute the relevant amounts you need to capture, then you need to report those amounts to the IRS, state government, and also for the users. And again, as CPS and practitioners, like you're receiving these information reports, but there's a lot of work that goes into kind of to the production of those information reports. And basically, if you're a broker and if you're one of those 5 categories of brokers, now you had to identify who is doing transaction on your platform. You had to compute their gains and losses and other income items, and you had to report those amounts in the correct form to the IRS, the state governments, and the users. Again, very, very cumbersome and very administratively burdensome task. Okay, moving on. So we spoke about the 5 categories of brokers. So the next question you might ask is, okay, what kind of transactions are subject to this information reporting? Cashing out, sale of digital asset into cash. If a user going from one coin to another, that creates a taxable event. So the new 1099-DA form will capture those transactions. We spoke about payment processes. If you're sending digital asset to a payment process like, BitPay, now BitPay has to, find out my ID and compute my basis and gains and losses and issue me a 1099-DA based on the proposed regulations. And then last but not least, the proposed regulations are also talking about the transaction fees. In some cases, these transaction fees get paid in cryptocurrencies. As you guys know, when you spend cryptocurrency and if that currency has appreciated, that triggers a capital gain or capital loss event. So these proposed broker regulations also want brokers to capture the gains and losses arising from these fee type of transactions. Again, it's very difficult to do these things with the technology we have today. But I'll talk about some of the industry pushback in the coming slides. But these are basically transactions that are subject to 1099-DA reporting when they come in the future. That said, there are also transactions that are not captured by the 1099-DAs. These include hard forks, airdrops, certain types of loan transaction, wrapping, and digital asset received for the performance of service. And this could be captured in other information reports, not the 1099-DA. So just know that like most of the common transactions, like the sales, selling into cash or crypto trades and fee transactions, they will be captured on these upcoming 1099-DA forms. Okay, let's go to the next slide. So what about the timeline? So we had a comment period for the proposed regulations, as Jared mentioned. CoinTracker was selected as one of the 12 companies who is eligible to share their opinion live with the Treasury and the IRS. During the hearing, IRS and the Treasury received over 100,000 comments on this subject. So this was a hot topic. Everybody, started caring about this because there's so many implications. Obviously there's administrative burden, privacy concerns, and all those things. I'll share some of our viewpoint on this subject as well in the coming slides and some of the things that we are trying to do to make sure that the Treasury introduces sensible regulations instead of trying to capture everything. So the proposed regulations came out and the comment period has now ended. So everybody's expecting final regulations sometime in 2024, sometime this year. Proposed regulations also mentioned that the proceeds reporting will go into effect the 2025 tax year, which is next year. I can tell you that it's very unlikely for us to see this timeline because I don't think even the most sophisticated brokers like Coinbase is ready to do proceeds only reporting for the 2025 tax year because you had to come up with the systems, you had to hire the right people and all those things. According to the proposed regulation, you will see the first round of 1099 for the 2025 tax year, but most likely the first year of proceeds reporting will be 2026 tax year, based on what we are hearing from the industry. In the following year, 2026 tax year or 2027 tax year, more realistically speaking, you will ideally see 1099 with both gross proceeds and cost basis. And by that time, again, hopefully, crypto exchanges will act very similar to stockbrokers, where users get like complete 1099 DAs. Hopefully, there could be a lot of reasons why it won't be the case, which I will explain in the next slides. So while we're going through the slides, I encourage you to ask any questions. I'm happy to answer if you have any questions on this subject. So once the proposed regulations came out, I think the first thing me and my team did was we actually spoke to like almost all the wallets and exchanges in the US and few outside the US to kind of get their reaction on that. So based on all the conversations we had, and I also read most of the comments that were submitted to the IRS, these are some of the comments. These are some of the reactions that we heard from the brokers and non-brokers. The main pushback was that these timelines were very unrealistic. I just explained the situation about proceeds reporting. Again, even the most sophisticated brokers like Coinbase is probably not ready to comply with these rules next year because, again, they had to track so many data points and it's unrealistic. The second biggest concern we heard was related to privacy. I spoke about information reporting. A part of information reporting is identifying your user, meaning collecting the PII, personally identifying information. So this directly contradicts with ethos of crypto. If you run like a decentralized exchange, now you're supposed to ask your personal identifying information from all the users. So a lot of people see this as the privacy risk. The statute is also saying that, again, not today, but in the future, like if I'm transferring something out of my exchange to a non-custodial wallet, the exchange is also required to collect the outgoing wallet addresses as well. So there are a lot of privacy concerns associated with collecting PII and kind of tracking where and how I'm doing transactions. The third pushback that we heard was the duplicative reporting. So this is a situation where one transaction could get captured by two brokers. So basically, I will receive multiple 1099 DAs with hopefully the same number. So in some cases, it may not be the same numbers. In those cases, taxpayers will be super confused. They're already confused about, crypto taxes, and imagine getting multiple 1099 DAs. They're reporting the same transactions, but they could be reporting slightly different amounts because each broker is using different pricing sources. So maybe one broker has access to the cost basis, the other broker does not. So again, duplicated reporting is a huge issue. The fourth one is kind of related to the third one. Crypto exchanges and wallet providers, they are really user-centric. They want to give really good experience for their users. And they're very concerned that if they start issuing these incomplete and incorrect 1099 DAs, that's going to negatively impact their user experience. So that is something that they will have to balance with this tax compliance framework as well. The last one is withholding challenges. So basically, again, without going into too much details, if you're a foreign user, and if you make certain gains, in some cases, the exchange has to withhold, income taxes on behalf of you. Now, this is doable if you do transactions in a centralized exchange or a financial institution like Robinhood, because they own your account. They know your identity, they can withhold certain percentages out of your gains. But if you're connecting your self-custodial wallet to one of these platforms, and if that platform becomes a broker, The platform has no realistic way to withhold money because the platform does not have any ownership over your funds because the platform is just allowing you to connect your self-custody wallet. So this is also a challenge. Again, the tax law wants you to withhold taxes from certain users, but those certain users have self-custodial wallets. So the platform has no control over withholding or doing anything over those wallets because, again, you own your assets. So these are some of the pushbacks that we saw from brokers, and these were reflected on comment letters submitted by Coinbase of the world, the OpenSeas and so many other people. Okay, so let's now talk about the practitioner and taxpayer perspective on the 6045 regs. We are very passionate about this segment of the industry because we are very close to them. As Eric mentioned, we have been in the business since 2017 and have been helping like over 2 million users and also tax professionals as well. So the main takeaway is that, again, 6045 regulations are great. It's going to make tax compliance super easy if taxpayers have just one centralized exchange. But in reality, that's not the case in the crypto world. Typical user has more than one exchange and they have multiple wallets and exchanges with transfers in between them. The keyword here is transfers. And if you kind of compare the crypto world to the TradFi world, in the crypto world, these transfer transactions are very common. There are a couple of reasons for that. Number one, the blockchain technology itself is designed to kind of transfer value from one location to another with just a click of a button. No paperwork, nothing. In contrast, like think about your stock portfolio. Like when was the last time you transferred your stocks from Robinhood to Charles Schwab? Like you didn't have to because like if you have just like one financial institution, it gives you access to all the stocks that you want to buy. But in the crypto space, that's not the case and these transfers happen. The second reason why transfers are very common, I'm pretty sure you guys have gone through this, no single exchange can offer access to all cryptocurrency trading pairs in existence at a given time. If I want to get like some obscure coin, what I would do is I would buy USDC on Coinbase, transfer that USDC to a different DEX and buy that coin, and that results in a transfer. And this transfer problem is actually very big. So on the right-hand side of the slide, I have added a chart. So this chart kind of based on the CoinTracker users. As you can see, a typical crypto user has like a lot of transfer transactions in a given year. In years like 2021, which was a bull market year, average CoinTracker user had over 25 transfers. Again, these transfers make reconciliation and cost basis tracking extremely hard. Because these transfers, most of the time they touch non-broker sources like, unhosted wallet and self-custodial wallets. So if you go to the next slide, so let me kind of give you an example that kind of shows like the problem that is actually brewing as a result of the 6045. So let's say I transferred one Ethereum from my unhosted wallet to Coinbase. And sells 80% of that entire coin for $2,000. So as a result of this 6045 regs, Coinbase will issue me a 1099 NDA with just $2,000 worth of gross proceeds, but it will not know the cost basis because I didn't buy that Ethereum inside Coinbase. So obviously in my case, like, having worked at CoinTracker, I know exactly how to get my cost basis, but for the average taxpayer, they're going to be super confused. They're going to have a very bad time, and they probably blame Coinbase for overstating their gains because obviously they don't know the details. And again, this is just a simple example, and you're going to see like a lot more of these examples in the coming years. Now, the next transaction that I do, again, very common transaction, the remaining 0.2 Ethereum, I transferred from my Coinbase exchange to Gemini and sell that 0.2 Ethereum at Gemini for 500. So Gemini here again, rightfully so, will send me a 1099 NDA with $500 worth of gross proceeds, but Gemini wouldn't know my cost basis because I didn't buy it in Coinbase. So the upcoming 6045 Cap A regulations is supposed to fix this problem. So basically in this situation, Coinbase is supposed to tell my cost basis to Gemini. So Gemini can put that cost basis when I sell that point to it for $500. Now, the problem is that in this case, Coinbase doesn't know my cost basis either because it got transferred to Coinbase from my unhosted wallet. So the point that I'm trying to make here is that whenever there's a non-broker, non-reporting location is involved with your transfers, your cost basis breaks, and basically your 1099-DA is going to be incomplete and inaccurate. So these frequent transfers, like technically speaking, they will create an unprecedented amount of non-covered tax lots. So non-covered tax lots, these are tax lots that are not visible to reporting brokers. And there will be a lot more of these type of non-covered lots in the crypto ecosystem compared to traditional securities, mainly because of transfers involving non-custodial wallets and non-reporting brokers. Okay, next point. So the good news is that even before the regulations, these non-covered tax lots, like taxpayers have used like crypto aggregators like CoinTracker to kind of maintain these things. Now, if you have connected your wallets and exchanges to CoinTracker, CoinTracker tracks your non-covered tax lots and even the covered tax lots across your entire portfolio. The opportunity the industry have today is that these brokers, these reporting brokers, have an opportunity to use that information coming from CoinTrackers of the world, or there could be other aggregators. So that way they can issue a more complete and accurate 1099-DA to their users, so their users are not going to be confused. IRS also has an opportunity to leverage this data, obviously with the user consent, to carry out their enforcement activities as well. So these are some of the conversations that we are having with Coinbases of the world and some other brokers. Basically, what we're trying to solve for is how can we make these future incomplete and inaccurate 1099-DAs more complete and accurate by leveraging the data these users have sitting on their aggregator tool. We are also co-authoring a paper on this. Again, one of the problems with the aggregation industry today is that, given the same amount of input there, sometimes the outputs are not consistent. So probably this is a time for the aggregation industry to kind of step up and come up with standards. So once you have these standards, these brokers are more comfortable using these missing cost basis information in their information reports. So we're kind of working, exploring some of these standards, like, completeness, like, how do you make sure that you have connected all wallets and exchanges to aggregator? Because if that's not the case, the data is not going to be complete. Comprehensiveness, how do we make sure aggregators are reading all transactions related to that blockchain or wallet? How do we make sure the tax accuracy? Because there's no standard for tax accuracy among aggregators today. What about the reliability? What's the uptime? What's the downtime? And also the security, data privacy, and portability of data. So we are actually co-authoring a paper on this. We have also spoken to the Treasury and some of the other regulators to kind of get their feedback. Because again, aggregators will continue to play like a crucial role in this crypto ecosystem because of self-custody. And if you self-custody something, your tax lots are only known to you. And aggregators help these users kind of, store these tax lots. So the question is, how can we enable users to signal these tax lots to reporting brokers? So that way, IRS is not going to get confused when they get the 1099-DAs, and the users can get like a more complete and accurate 1099-DA. So these are some of the conversations that we are having with the industry leaders today.
So now let's zoom out a bit and take a look at the market itself, right? So we've been heavily focused on the tax professional market, specifically those working with private clients, so 1040 business, really for a couple of years, but hyper-focused for the last 6 to 8 months. And so wanted to share some of the basic observations, challenges, opportunities. So first of all, why are we focused on this? We like to meet users where they are, right? So historically, that meant partnering with people like Coinbase and Uniswap and OpenSea, right? Some of the large crypto platforms, because these are large concentrations of crypto users who need tax support. And that works really well. But as it turns out, people are often with tax pros as well. So we know that 50% of people file with a tax professional. And we know from our platform data that almost 50%, 44, of sovereign crypto users file with a tax professional. And when we say sovereign, this is really a crypto power user. They self-custody, likely interact with DeFi protocols, maybe trade NFTs, and transact across multiple venues and wallets, right? So a little more complex. This is a group we care deeply about, and it turns out they're also using tax professionals. So it's a large market and it's important. And as crypto gets more complex, at the same time, regs are becoming more clear. So we think increasingly people will need support from professionals. So important market, lots of users are here. Then also this market is growing, right? The addressable market will continue to grow. And there's two main drivers there. So one is the compliance rate, right? Today, it's around 10 to 15%, meaning out of every 100 crypto users, 10 to 15 are tax compliant. So as that moves closer to 100, the market has a lot of room to grow organically. And then, of course, that's all accelerated and expanded by continued crypto adoption. So important market, lots of room to grow. And so with that in mind, we've kind of doubled down on this channel, right? It's really important. And so we spent the last, over 6-8 months really immersed in the space, talking to tax professionals and accounting firms of all shapes and sizes. And so I wanted to share a few things. So here's what we learned. So as you know, this market's very fragmented, right? The addressable market is thinly spread across many, many firms. This is a very simple market map. We typically look at firms in 4 different buckets, and each have ranging complexity, product needs, size, and importantly, there's a wide range of the level of interest in crypto as a topic, or the focus applied to this asset class. So starting from the left, you have what we'll call mom and pop, which is typically sole proprietors or 1 to 3 person shops. Their needs skew more simple generally. There's about 50,000 of them, so it's an important market. And largely not so focused on crypto as a specialty. Then you have mid-market firms, right? And this is a wide range of size in this bucket. There's about 1,000 of these. And I'd say it's mixed in terms of focus. So it depends on the firm. Some are leaning in, some are not. Now, a subset of that group is what we'll call crypto specialists, right? These are firms that are leaning into crypto. They're switched on, they have expertise, and they're actively growing the crypto practice. Often this represents 100% of their business or at least a large chunk. So they have expertise and their needs are the most complex and their clients are the most complex, right? These are folks that service a lot of those sovereign crypto users that I talked about. And then finally, you have, we'll call large firms. This is generally the top 50 firms by revenue in the US. The focus is mixed, similar to mid-market, where some firms are leaning in and building large digital asset practices. Others are still wading in the water and figuring out what the strategy is, and some are turning away, right? So it's very mixed. So there's a quick view of the market. Now, if you drill down into those practices, right, of the firms we've talked to, here are some of the stats. There's a wide range of size. So a practice can serve anywhere from 5 to 500 crypto clients. I'd say the average firm we talk to services around 50. And it typically represents 5 to 10% of the total client base. That number is much higher for the specialty firms, closer to 100. And one takeaway here is growth. Often I hear that growth is led by word of mouth, right? Crypto, as you know, is a very tight-knit community. So seemingly, if you take care of one client, they'll bring you another. So it's a nice way to grow. Okay, so then within those practices, right, how are the tax pros servicing these clients, right? We've seen all sorts of methods, but you can bucket them in 4 major groups. So the first is what we'll call document dump plus Excel, right? This is where a client will pass CSVs, PDFs, other documents, and you'll make sense of it through pivot tables and your own proprietary model. This is super impressive, but often can be done more efficiently. Next, you have product agnostic. So this is a more passive approach. This is where the firm will defer to the software that the client uses. Then 3 and 4, you start to get into, this is more common with firms that are more leaned in to the topic. But this is where you're taking more of a point of view, right? So 3, you might use multiple tools. You've used many, you've decided 3 are the best fit for you, and you select a tool based on the client situation. So for example, if someone comes in with heavy DeFi activity and you know that CoinTracker handles DeFi really well, you would select CoinTracker for that client. And then finally, one tool to win them all, right? This is where you've surveyed the market and selected the highest quality tool. Maybe you've gone off for RFP, right? But you select one tool to serve a majority or all of clients. And the trend here I've seen is it appears most firms started with more of a passive approach and they've accumulated many tools over a few tax seasons. And at some point that does become a headache. It becomes a little messy. And so I see firms starting to consolidate down to a handful of tools, if not just one. So that's how generally tax pros are servicing their clients. All right, so then while they're doing that, what are the pain points that they feel most? This stuff's tricky, right? Crypto taxes are hard, and there is a lot of pain. I listed 4 here that we hear the most, right? So the first is low quality tools, right? Not all tools are equal. Some can be inconsistent, unreliable, and inaccurate. So in that case, as a tax pro, you don't have peace of mind. So that's tricky. Then next, as I mentioned on the last slide, using multiple tools can be a headache at some point. So you have to train up on these tools, stay updated on these tools, manage clients across these tools, right? So there's often a desire to start consolidating, as I mentioned. Then next is handling complexity, right? When clients come in that are more complex, those sovereign users, again, with lots of DeFi activity, NFTs, and higher transaction volumes, this is where a tool is very critical, right? So you need a quality tool for this. It's very difficult to manage those without one. And then finally, and I'd say we hear this the most, which is wasted time, right? You can spend an awful lot of time on these accounts, and often that can be unbillable. And so saving time is a huge need for this space. And takeaway here is, with the right software stack, you can alleviate a lot of these pains. So then what do tax pros want, right? What have we heard? What are the main needs? As I said, saving time is first and foremost. This is what we hear the most. And this is basically, hey, reduce the manual toil, right? And with all that time saving, now I can spend more time on high value activities. So things like planning, optimization, tax loss harvesting, right? Providing more value add and less of that manual toil in spreadsheets. And then next is you have to trust the data, right? Tax pros demand extreme accuracy and they want that peace of mind. And so what does that mean? One, it's have a breadth and depth of coverage, right? Crypto is a massive universe. So you want to cover all of the client's use cases with high quality integrations to different wallets and exchanges and chains, et cetera. And then backing that up with a high quality accounting engine, right? So you can apply the right treatments and have accurate calculations. And then the cherry on top would be optionality and having the ability to customize, right? Toggle different accounting methods, things like that. And then finally, said simply, it's like crypto taxes that just work. Everyone's so busy, like you want things to just work. You want a high quality software to recommend to clients, and one that's has a dead simple user experience, right? And one that's delightful. And then all wrapped up in a good support model, because no matter how good the software is, there's always a question, right? And so you want to feel supported, especially when things get busy. So to wrap this up, one last point to make is, look, this stuff is important, and it presents a pretty interesting opportunity for firms of all sizes. So we know the market's quite large, right? 1 in 5 Americans own crypto. And as we talked about, that market will continue to grow, right? Two drivers there: as compliance rate moves from 10 to 15, closer to 100 over the next few years. And as crypto adoption marches on, the market will continue to expand. But at the same time, it's pretty niche, and there's limited expertise today. So if you're qualified and you have expertise in this space, you can often charge a premium. And by doing that, you attract a pretty interesting demographic. Crypto users can skew higher net worth and have complex situations where it can make for a nice relationship going forward. So yeah, go build a practice, scale your practice, and I'd say that, CoinTracker and other software tools can be a foundation for that and help you efficiently scale.